In the mid-2000s, a Nova Scotia dentist named Gordon Rudolph wasn't just fixing teeth. He was chasing one of the most ambitious petrochemical projects Canada has ever seen through a company called Celtic Petrochemicals. The plan was to build a massive plant in Goldboro, Nova Scotia. It needed billions in funding, and Rudolph poured himself into it, buying shares, stock options, and even joining the board of directors. Hi, I'm Amandeep Singh, CPA, and today we'll walk through what happened when his investments collided with the Canada Revenue Agency. The central question before the tax court was this: was Rudolph's gain from selling over 900,000 Celtic shares business income or a capital gain? Here's why it mattered. If it was a capital gain, only half would be taxed, and taxpayers sometimes even get to use the lifetime capital gains exemption. If it was business income, on the other hand, the full amount would be taxable, but business income lets you use non-capital losses to offset it. Now, here's where things get interesting. Most people hope for capital gains because they're only 50% taxable, but Rudolph argued for business income. You will ask why? Well, because in 2008 he had a huge $500,000 loss from stock options that expired worthless. If that loss were capital, it could only offset capital gains. By treating it as a business loss, he could apply it right away against his business income and even carry it forward to later years like 2009 and 2012. On the top of that, his shares did not qualify for lifetime capital gains exemption, so there was no big tax-free benefit on the capital side. For him, income treatment was the smarter move. The court reviewed everything carefully. The CRA argued that he sold shares partly in 2007 and partly in 2008. Rudolph said the transfer only happened in March 2008, and the records backed him up. Celtic's corporate letters, share certificates, and emails all confirm that shares moved on March 4, 2008. So the 1.3 million he got from Mumsco in 2007 wasn't a purchase price. It was an advance so he could buy more shares and keep control at the board level. The court agreed. It ruled that the 910,000 share transfer took place in 2008. It also ruled that 966,000 profit was business income, not a capital gain. That meant Rudolph had to report the full amount as taxable income in 2008, but it also meant his 548,000 loss from options was treated as a business loss, which could offset that income and carry forward to other years. On interest expenses, however, Rudolph lost. He tried to claim over $70,000 for 2007, later adjusting to about $52,000. But he could not clearly prove what the borrowed money was used for, income earning purposes or not. The court said vague explanations were not enough, so the deduction was unfortunately denied. In the end, Rudolph won the big issues. The court sided with him on the timing of the sale, the treatment of his profit as business income, and the classification of his losses. The reassessments were sent back to CRA for correction, and he was awarded costs. For business owners and investors, this case is a reminder that the line between capital gains and business income depends on facts, which is your intention, how often you trade, whether you used borrowed money, and how involved you are. Getting it wrong can mean years of fighting with CRA. That's where a firm like Cloudiver CPAs in Burnaby comes in. Think of us as your Google Maps for tax, guiding you to the best route, whether it's capital treatment or business treatment, so you don't end up lost in a tax dispute. I'm Amandeep Singh, CPA. Thanks for watching, and I'll see you in my next video. Until then, bye.